Welcome to SB Talks. Today is Monday, November 4th, and I am joined, as ever, by our trusty Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, as Nick and I sit here, we are about 24 hours out from the US election, so inevitably we'll be discussing that and the market positioning at present. We'll talk about last week's Australian inflation data and that sticky underlying number, as well as the latest on US earnings season. Welcome to all our listeners. We sit here about 24 hours out from the US presidential election. Presently, polls have it as a very close call. Might open with asking how markets have been behaving in the lead up to the election.
I think what we usually see in the lead up to election is a little bit of uncertainty, a little bit of volatility, and we've definitely seen that in the last week. So it was quite a weak week for equities. The S&P was off 1.5% roughly, and Australia was down about 1.1%. And we're seeing bond yields continue to march higher.
Yeah, let's talk about that. What's sitting behind that, do you think?
I think it's largely what you'd call the reflation trade. Basically, people are more optimistic about the growth outlook. The economic data has been better, leaving aside the non-farm payrolls from last Friday. Generally, the data has confirmed the US economy is in pretty rude health. And so we've had a lot of the rate cuts that were priced in sort of wound back, really. And then there's, some speculation that the Fed might pause, skip a meeting, all that sort of stuff. So we've seen, I guess the better growth outlook has led to higher bond yields. And also, I think there's probably some element of expectation of a red sweep, a Republican sweep of Congress, and a Trump presidency that would see further bigger budget deficits in the US.
Yeah, well, let's talk to that for a little bit if we can. So his platform is discussing, obviously both candidates have big spending plans, let's say in their mandates or their proposed mandates. Trump also brings that with sweeping tax cuts, corporate tax cuts in particular, which could potentially push, let's call it a fairly ugly deficit situation to be quite a bit worse than that.
Yeah, I mean, the biggest loser of this election is the budget deficit. So whoever wins, there's not going to be a lot of improvement. I mean, at the moment, we have a deficit running at about 7% of GDP, and this is an economy that's in rude health. And there's really no signs on either sides of Congress to try to rein that in. Using this Congressional Budget Office forecasts, if the status quo, just what's already kind of legislated, continues, then debt to GDP in the US will rise from 100% to 120% over the next 10 years. Now, if Trump gets in, that picture gets worse, and I think so. You've seen maybe the bond market start to price a little bit of that in. Obviously, they don't know what the final makeup of the US Congress will be and whether it will be a red sweep or a divided house. So there's maybe a little bit of pricing for that as well. And
probably a market preference for a division, no sweep, just to try and keep any of those bigger, more outlandish plans in check.
Yeah, I think, often a divided house is the best outcome for markets because then you don't get those radical changes. Now, we know Donald Trump has executive authority to introduce tariffs.
Yep.
So there's an element of that as well, I guess, that markets are trying to sort of get their head around.
But with a pickup in the bond yield, particularly the long-term yield, it's driving up the cost of financing that debt, and it's starting to become a more and more meaningful component of the budget itself.
Well, that's right. The cost of the interest bill now is bigger than the amount that the US spends on defense.
And we know that they spend pretty heavily on defense.
Yeah. So it's a problem. But for now, markets are kind of happy to, let it play out. Maybe price in a little bit of that premium rebuild of what they call the term premium to reflect some uncertainty around the path of debt.
Yeah. Now let's take a step back, and you spoke before about some of the broader health in the US economy, and there has been a bit of discussion in recent weeks around whether the 50 basis point cut was really needed or merited.
Yeah, I think the markets, certainly they were taken by surprise when it was announced. The Fed was clearly worried about faster than expected slowing of the labour market. We had some, you might recall back in July and August, there was some sort of soft labour market prints, but that was all put to bed with the September number, which was originally reported at 254,000. And therefore, people said, maybe the 50 basis point wasn't warranted. And even some Fed officials were sort of backpedaling a little bit. And there was some suggestions that maybe the Fed could maybe skip a meeting, not do a 25 basis point cut, or do sort of cut every second meeting, something like that. But we had the non-farm payrolls report for October that came out on Friday. That was the weakest number since December 2020.
Right.
Just 12,000 jobs created. Now, of course, there were hurricanes. We had 2 hurricanes. We had the Boeing strike. So there's a lot of noise in that data. So the market didn't get too stressed about that, but there were negative revisions the prior 2 months. So that 254,000 originally reported was revised down to 223, and there was another 80,000 revision down to the prior month.
So showing that the broader trend still remains relatively
I think
weakening.
the labour market is definitely cooling in the US, which is probably a good thing. But then there was some other data. For example, average hourly earnings were a bit stronger. The unemployment rate was steady at 4.1%. Average hourly earnings were 0.4 or 4% year on year. So it was a bit of a mixed picture. But broadly, I think it confirms that the labour market's cooling, which is probably what the Fed wants.
Where's the market pricing the Fed to go from here? What are we thinking before the end of the year?
Yeah, so they're meeting this week, and 25 basis point is pretty much locked in for this week. The meeting after that in December, a little less than 25's priced, so I think it's at probably about 20 basis points priced.
Likely to happen in December, but not as strongly as we're expecting.
I think they'll want to see what happens with the November payrolls report, whether some of that noise, with the hurricanes kind of reverses. So I think they'll be very data dependent. I think everyone agrees that they are still on a path to reduce the rates down to around 3.5% by the middle of next year. They've decided they don't need to be restrictive anymore, and that's where they roughly probably is neutral, is around that 3 to 3.5% level.
Well, let's stay on that topic, talking inflation. In Australia, we had updated data through last week showing underlying inflation still a bit more sticky than we would like.
Yeah, so the number came in a little stronger than what was expected. So 0.8% on the trimmed mean versus 0.7% expected. That's down from 0.9% the prior quarter and 1% the quarter before that. So there's a gradual tick down, but it's not
very gradual.
It's not coming down very quickly. The headline rate was a lot lower, but obviously impacted by some of those energy and rent subsidies that kicked in,
which we're talking about on the podcast.
Yeah,
going to be a bit of an artificial influence.
Most market participants ignore that and just look at the trim mean and saying, well, it's come down from 4% to 3.5% year on year. It's heading in the right direction, but is it coming down at a speed that would give the RBA ammunition to cut rates? And I think the answer to that is no.
Not yet.
And that's why we've seen really the bond market push back the first rate cut until May of next year. Now, it's possible that if we get another good print, in the at the end of January, that they could move in February. So a few economists have a February cut. But yeah, it's not.
That's the best we can hope for.
That's the best we can hope for at this point.
And there's a lot of, with an Australian election coming up, at least by May, there's sort of a lot of political will or a desire to see some cuts before then, just to ease cost of living pressures. But the RBA doesn't necessarily need to pay any attention to that.
No, and we know like the US, the labour market here is still pretty strong. Unemployment's been steady at about 4.1% for the last 6 months. There's been a lot of jobs created in the care economy, so hospitality, health, education, and government services. So the government sort of spending is not making the RBA's job easier. And we know the RBA wanted to hold on to some of those job gains, and that's why they didn't lift rates as high as other countries. And so they've probably tended to favour the labour market over the inflation a little bit.
Yep.
And that's why.
But having not lifted as high, we don't have as far to cut when we start, so
that's
all
right.
the more reason to potentially sit on the sidelines a little bit longer.
Yep.
We're seeing some US earnings season. What's catching your eye there?
Yeah, it's been another pretty good earnings season. So 70% of companies reported, 59% have beaten revenue expectations, and 77% have beaten earnings expectations. Earnings have grown about 9% year on year, so pretty good.
Yeah.
The standouts is healthcare, financials, communication services, and IT. There's standout sectors.
And what about
really
our friends in the Magnificent Seven? They're we talked about them being priced for, maybe if not perfection, certainly something pretty close to it. Are they able to satisfy the market?
Yeah, look, it's been mixed. Tesla had a pretty good result. Google, Amazon had good results that were well received by the market. So Google, for example, their advertising revenue was particularly strong. Amazon's margins were pretty good. Apple, Microsoft, and Meta, more mixed. So Meta had good results, like their advertising results were good, but they warned of significant increase in capital expenditure for AI related stuff going forward, and which is something we've spoken about before. And same with Microsoft. I think there was concerns about just how much they're spending, and also their cloud center growth maybe wasn't as good as the guidance.
Good, was it good, but was it good enough?
It wasn't good enough. And then Apple has got issues with China, which is sort of ongoing. And then, I think over the weekend we heard that Berkshire Hathaway, Warren Buffett's investment vehicle, been dumping Apple shares. So maybe Apple is probably, not doing as well.
Yeah, I guess question marks over their ability to continue their growth. It's certainly made a huge amount of money for Berkshire Hathaway in recent years, so interesting move there. Anything else around the world sort of filtering into your thinking at the minute? European GDP numbers?
Yeah, look, GDP numbers in Europe were pretty good, actually better than expected. So Germany, people were worried might go into another technical recession. Their economy shrank 0.1% in the prior quarter, but actually surprised to the upside, growing 0.2% this quarter. So that lifted overall Eurozone growth to 0.9% from 0.6%. So that's not great numbers, but it's not going backwards. At least that's something. And the US economy, we got GDP numbers from them, first estimates, and their economy grew at 2.8% annualized in the September quarter, with very strong consumer spending, investment, and government spending. So, they still appear to be the sort of standout economy in terms of growth at the moment, the US. So overall growth's, pretty good, picking up a little bit. I'm probably more glass half full, a bit more optimistic.
Yeah, ask, as an allocator, how does it make you think about the world?
Well, you got to look, growth's, improving. Unemployment is still pretty low. Interest rates are being cut. Corporate earnings are pretty good. So it's all pretty good. And, maybe once we get through the US election and the uncertainty around that, and we have more transparency about what the new administration will look like, that could be quite good. So I'm reasonably optimistic.
Reasonably optimistic. That's an excellent note to finish on. I think we'd all possibly just love a decisive and non-contested result out of the election this week, but even that might be too much to ask for. But thank you, as always, Nick, and thank you to all our listeners.